Good morning. Welcome to my e-learning YouTube channels. Today we are going to discuss about unit number 5 on corporate board and committees. Under that concept, Cadbury committee and OECD principles. So these two international committees, or we can include about that is the international company reports, how these corporate boards and committees we required in the country wise or maybe the international levels has to be discussed today's video. So let's discuss about today's. We'll go for Cadbury committees. Now this committee basically is, when you discuss about this committee, Cadbury committees, is very familiar with the concept of corporate governance, how the corporate governance is required in the international way. So basically we'll go for this committees as a historically how this committee has been formed, and then we'll discuss about that how this committee has given the reports. Okay, so this committee has been set up in the year May 1991 by the Financial Reporting Council of London Stock Exchange basically, and this committee has been given this report on December 1992. See that it is framed or it is maybe set up by London Stock Exchange by the Financial Reporting Council in May 1991, and the committee has given the report as published in December 1992, the next years. And this committee chairman, it is Adrian Cadbury, that the chairman of this Cadbury committee, the chairman of that person, and the chairman name only is they given that committee for the purpose. And to be this framing this committees, the intention of this committee has been framed to know that governance systems in the corporate governance systems in their company, and the report set out this recommendation on this arranged by the company boards accounting system to mitigate corporate governance risk and failure. So basically the report has been set the recommendation of how the corporate boards, then arrangement of corporate boards in a company, then accounting system, and the corporate governance risk and its failures basically. So this committee has been focused upon the code of best practice. If you want to be follow the good governance system in your organizations, then good governance system, the code of best practices they are going to be decide. So what are the code of best practice they decide? The role of board of directors, basically how the role of board of directors is there in your organizations, their duties and their compositions, how we are going to be composite various boards. Then role of non-executive directors. Number third, dealing with their remunerations. And number four, that is addressing questions of financial reporting and financial controls. So this committee talks about that if you want to be maintain the good governance systems in your organizations. So basically these are the four best practices that every organization should follow. That what things, the role of board of directors, then non-executive directors role, their remunerations, and their addressing the question related to financial reporting and financial controls. Then we'll discuss about in details how these best practices will be there. First, it is role of board of directors, that how the board should be there in an organization, their duties and their compositions. So basically Cadbury committee talks about that board should meet regularly. Basically fix the time, that is the meeting time should not be more than 6 months, and the board should include non-executive directors sufficient caliber. So whenever the board meetings will be there taken place, so we should include that non-executive directors. All directors should have the access to advice and service of the company secretary. That is also very much important things. Only the chairman or the CEO or maybe the majority minority peoples cannot be considered the entire decisions. So all the directors on the board meeting should access the advice and service of the company secretary. Then next it is role of non-executive directors. Basically the non-executive directors are the directors who are, as we include about, that is not an executive director. So it should be, as a non-executive director, should be independent judgments, and it should be appointed for specific term purpose only, not for regular terms, and it should be selected through formal process only. So what formal process are there as per the company's rules or company standards or the as per the company's act? As per that we can be appoint or we can select, or basically we should give that non-executive directors the special provisions has to take independent judgment, not on behalf of or not in the base of or not on account of, or we can take that as independent to be has maintained the true and fair result of the companies. Then comes to number third, dealing with their remunerations. So how we set the remuneration patterns related to executive directors, non-executive directors, because we are appointing non-executive directors for the specific terms. So how we are going to deal with them, and here we has to be thinking about the remuneration point of view. So here it recommends that future service contract should not exceed 3 years without the shareholders. So if you are appointing any non-executive directors or directors, or maybe the other board members, it should be recommend the service contract not exceed 3 years without shareholders. If you want to be exceeds, you should take a permission compulsory from shareholders. Then the remuneration of directors should be both fair and competitive basis. So it should be true and fair basis, what the task we are given or what duties we are going to be assigned, and it should be competitive. And ultimately the AGM provides the opportunity for shareholders also. The annual general meeting provides the opportunity for shareholders also to know that our company's pictures or how the company has been progressing, or the AGM will be approval of that your remuneration of the non-executive directors and the directors positions. Then another important thing is number 4, that is addressing question of financial reporting and financial control. This is very much important practice in an organization, that every board should be give that question answers, how that financial reporting we are maintained and what things we are going to be taken place. Basically that it is the duty of board to be present assessment of all financial activities, and should be give that the clear ideas how this financial activity we are going to be taken place. Also professional relationship is maintained with auditors also, not personal. We should maintain only professionals, no personal relations, no other relations we should maintain with the auditors, and establish an audit committee. It is compulsory for every organization as per the Cadbury committees. Again, the directors should explain their responsibility for their preparing accounts also. So when we have to be considers that the director should explain what are the responsibility of preparing accounting. Then the report should be on the effective uses of company system and internal control, and the director should report that business is going concerns, how we are going to maintain that records, how we have to be taken the decisions. So that we have to be considered as a 4 best practices. Apart from 4 best practices, some of the major recommendations that Cadbury committee has been talked about, that is a single person should not be vested with decision making powers. That is very much important. The non-executive directors should act on independently, not on dependent on any others. Our majority should independent directors and non-executive directors. Then term of directors can extend beyond 3 years only after the prior approval of shareholders. So the directors or non-executive directors, as per the contract, it should be 3 years. If you want to be extend, you should take the approval from shareholders. And the remuneration of that non-executive decide on the pay of executive directors. The interim company report should be give the balance sheet information reviewed by the auditors. This is very much important as a financial point of view. It should be reviewed on timely basis and as by the auditors. The information regarding audit fees should be made public, and there should be regular rotation of auditors also. We cannot be fix any one auditors. We should be rotate the auditors. It will get the true and fair financial position of the company. And objectives of professional relation with auditors, and it should be reported by the business concerns. So this is what related to as a part of Cadbury committee. So what overall Cadbury committee talks about, that if you want to maintain good governance system in organizations, or how the corporate boards and committees will require. So basically Cadbury committee talks about that is the 4 best practices, how we'll maintain the good governance systems, that has to go for as a control of the organizations. Then the position of non-executive directors, the remunerations, and ultimately how we are going to maintain that financial reporting activities. So that is the main things where we have to be discussing that Cadbury committees, and these committees report has been very familiar, and that every country has been followed that Cadbury committee recommendations to be maintain the good governance system in the organization. So this is what related to as a Cadbury committee recommendations. Then one more as a international principles, or we can consider as a committees, or we can include about principal point of views as per the syllabus, that OECD, that is stand for, that is your Organization for Economic Cooperation and Development. So basically this OECD also another important organizations where we talk about that how this OECD that is will consider. So we'll go in depth, that is how this OECD will talk about the principles of good governance systems. Contemporary discussions of good governance tend to refer to principle raised by three documents released in the since 1990. So how we are going to be maintained that purpose, the some of the principle has been raised in the document released in 1990, that is the Cadbury report on 1992 by UK, then principle of corporate governance by OECD in their 1999, 2004 and 2015, and the Sarbanes-Oxley Act 2002. So basically international point of views. So these three important reports has to be given that how the good governance system raised through this document, that is Cadbury report 1992, OECD 1999, 2004 and 2015, and Sarbanes-Oxley Act, that is for 2002, Act of 2002 of US 2002. So historically how this OECD and the good governance system talks about, basically the Cadbury and OECD report present the general principle around which business are expected to operate, assure proper governance, means how we should be maintain good governance to be operated as a business. And Sarbanes-Oxley Act refers to the attempt by the federal government in US legislative council regarding the recommendations or the principles will be followed by Cadbury and OECD reports. So we'll go for that what OECD has been talked about. So OECD, that is Organization for Economic Cooperation Development, has focused upon that if you want to be good governance systems, they have set some of the principles. So we'll go for that principle what they have said. So here the principle number 1 they talks about, that is ensuring the basis for an effective corporate governance framework. So every organization has to be set that effective corporate governance framework. So what corporate governance talks about, that is it is a system of your how we are going to maintain your accountability, transparency, then responsibilities and fairness. So that the pillars of corporate governance, how we are going to be based or how we are going to focus on that to maintain good governance systems. So what standards or what things we are going to maintain. So basically the fundamental principles of governance will work, how we should maintain. Every organization should be accountable, it should be transparency, it should be responsible, then and it should be fairness. So this is what the principle number 1 as corporate governance. Then number 2 has to be go for that principle number 2 we are going to be consider, that is as a point of view, that is the right and equitable treatment of shareholders and key ownership functions. Basically this is very much important. So you should give the right and equitable treatment for all shareholders, and if they are capable to become ownership, then it should be provided that as ownership function also. So shareholders want that regular returns, and some of the rights related to be in a appoint or will be removed some of the directors, or maybe present AGMs or major decision purpose shareholders opinion also take place. So you should take that shareholders point of views also, so that will be getting confidence to the shareholders to become that is continuously for longer periods. So it will benefit to as an organization only. So then that is where we can consider that the rights and equitable treatment should be given to the shareholders. So that is to consider the principle number 2. Then principle number 3 we has to go for that, has to be considered institutional investor, stock market and other intermediaries purpose. Now here basically where we talk about that stock markets, as every company's shares has been listed in the stock market, so it will be affect to the company's performance when any insider trading taken place or any misleading information taken place, or any intermediaries or institutional investor are making that is misleading of informations will impact your company's performance. So that here the principle number 3 talks about that every institutional investor or the stock market and other intermediaries should and will be reliant to the fair and true basis of information. It should prohibit to the insider tradings, and you should work as per the rules, or you should be deal with that as per the rules and regulation of the stock market activities. That is principle number 3. Then principle number 4, that is the role of stakeholders in corporate governance. That is also very much important thing. Not only shareholders has to play important role, but your stakeholders has to be fulfill very much important roles, as maybe the stakeholders may be your employee, that stakeholders may be your shareholders, or maybe your government, or maybe your suppliers, or maybe your community also. Every stakeholders has to be fulfill the requirement. So if you fulfill the stakeholder requirement, automatically it will benefit to the organizations only. So the principle number 4 talks about that you should be the fix the role and should be fulfill the requirement of your stakeholders also. Then principle number 5, that is very much important, the disclosure and transparency. Anything we are taken the decisions in the organization, it should and must disclose, and it should be transparent to each other, so it will be leads to the honesty and trust of general public to the organization, or the shareholders trust to the organization. So anything happens, maybe that will be as a true basis, or maybe any things to the against of company also should be disclosed to general publics, related to the remuneration, related to appointment or removal, or maybe mergers, acquisitions, or maybe we are going to be disclose some of the positions, or we are going to be add some of the business or remove some of the business. So it should be as a transparent basis. So that is very much important principle where we have to be considered basically as a OECD principle. And another important thing, that is responsibility the boards also, that board should be meet regularly. Board has to be assigned some of the duties for various directors, the role of non-executive directors. Then it should be fix various committees to their responsibilities, and how the board will be respond to link as a between management, or how the board has been given the plans to your organization's point of view. So that will has to play, and ultimately should be control, the board should control the entire organization. So that is also play important roles in the principle number 6. And what things will be considered as a disclosure and transparency, that every company should be financially and operating results should be, the company should be disclosed, company's objectives. Then ownership pattern is very much important, and their voting rights, because this will leads, as if you are very much transparent and disclosed to the general public, so it will be getting benefited to organization only, because that shareholders will trust on your organizations. Then members of the boards and key executive remunerations, how many members are there, so how the key executive role is there, how we are going to paying the remunerations. Then risk factors, governance structures and policies. And apart from that, where we have to consider that the employees and other stakeholder relations, or any issues related to organizations or maybe employees. So this is what related to as a OECD principle, that is Organization for Economic Cooperation Development, talks about some of the basic principles, where how the principles should be related to rights of shareholders, then principles related to disclosure and transparency, principle related to stakeholders point of views, or maybe the corporate governance point of views, or maybe the role of the corporate board. So overall, both the committees, or we can consider one committees and one principle, talks about that every organization should maintain good governance purpose. They has to go for to adopt these principles, or this committee recommendation, best practices, and 6 principles. So that will lead as a good governance systems. So ultimately, it should be has to be good control in the organization if you want to implement this OECD principles and Cadbury committee recommendations. Thank you.